Hello everyone, Stephen here. I am a risk professional that specializes in ERM, internal audit, and internal controls. From the last video, I got feedback from a good friend that I should put on a dress shirt. I usually record these videos at night after my daughter's asleep, hence why in my last video I was in a t-shirt. But feedback taken. I have a dress shirt on now. I'm always open to feedback. I want to make these videos better, so do let me know if you have any comments or feedback on how I can improve these videos. Today we will be talking about how to set up internal controls over financial reporting program, also known as ICFR. In my earlier video, I did give a brief intro on what ICFR is, but to summarize, organizations that are publicly listed, whether it's on the TSX, NYSE, or other jurisdictions, they do require management to have an established, robust, effective internal controls on the financial reports they issue to the shareholders and to the public. Due to previous frauds, financial frauds and scandals, governments have placed heavier emphasis on ICFR, with some requiring both management and the external auditors to test on the effectiveness of ICFR. Therefore, it is critical for us to get the ICFR program correct right from the get-go. Now, disclaimer, it's always important to consult your external auditors when it comes to your ICFR program approach. Different organizations, different jurisdictions can have different requirements. When I work with my clients, though, to set up an ICFR program, we always start with what is quantitatively and qualitatively material on their financial statements. Quantitatively, we want to benchmark against the external auditor's materiality, industry practices, and internal management perception of what is material from a quantitative perspective. For example, majority of the companies will say that quantitatively, revenue will be material as it does represent one of the bigger numbers on their financial statements. Qualitatively, we will look at accounts and processes that may not be material from a quant perspective, but can have a major impact on shareholders' decisions. An example of this would be contingent liabilities. We have to make sure there are appropriate controls in place to make sure the contingent liabilities are disclosed properly in the notes of the financial statements. Once we've determined the material financial statement accounts, we can consider these as the in-scope accounts. Now, don't get me wrong, we should still look at the immaterial accounts at some point, but for the purposes of efficiency and resource allocation, I always recommend to focus on the key accounts first. For each of the in-scope accounts, we have to determine what are the major risks associated with those accounts. From there, we'll be able to identify the appropriate controls to set up. To determine what the risk would be, we can go back to the basic 101 financial statement assertions. For example, using revenue again, the typical assertions would be existence, completeness, accuracy, valuation, and cutoff. Thus, the controls we have to implement have to address these assertions. Once established, management and the third-party consultants, internal auditors, and the second line of defense must work together to educate the control requirements to the control owners. It's important to educate these control owners on not just how to execute the control, but why they're doing it. What is the risk they're trying to mitigate? By increasing the level of risk and control awareness, organizations will be able to increase the strength of their control environment. Thanks again for watching. If there are any questions, please do reach out to me. Otherwise, stay safe everyone. I will see you next time. Take care.